Hey everyone, welcome back to my new channel. I'd like to talk to you about something. I lost about $300,000 last year in my net worth, and I'd like to tell you what I think about it and how you should handle it. So before we get going, please like and subscribe so you can follow when I release new episodes. So I'm not going to hide the lead. Yeah, I did lose about $300,000 in net worth last year. Where did it go? So according to Zillow, my house, the high point last year it was 754, and this year it's 664. So that's a loss of 90K, $90,000. So that's 90,000 of the 300,000, and the other 200 and change was from the stock market. So I do have a big chunk of money invested in the TSP through my employer, which is the Thrift Savings Plan, and it's invested in a combination of a fund that mirrors the S&P 500 and an index that is more small cap weighted and an index that's more international. So 3 index funds. And as you remember, towards the end of the year, there was a big crash in the market, the tech rout. A lot of the big names like Microsoft, Google, Amazon, Netflix were all hurting. And when you have a lot of your money in an index fund, the index fund is what they call cap weighted. So the bigger companies represent more of the index than the smaller companies. So for instance, Apple represents about 6% of the index, so does Microsoft. So if those companies lose money, then your index will probably go down. And if a smaller company loses money, you probably won't see that reflected very much in the index because the smaller companies represent a smaller amount of the index. So it's like whether you take a class in college that's 5 credits or you take a 1 credit gym class, the 5 credit class is going to move your average a lot more. And that's how index funds work. The bigger companies represent more of the average. So a lot of the losses were in that index fund. And also I invest in individual stocks, and I don't recommend that for most people, but I do it for myself. And it is something that does require a lot of work. And in my prior career, I was a mergers and acquisitions attorney. So I used to work on a lot of these transactions that would involve me drafting SEC filings. And so as part of the work that you would need to do if you want to invest in individual stocks, you'd have to do a lot of research, and that would involve reading SEC filings, which are not fun reading. But I think it's a necessary part of it if you're going to invest in individual stocks. So that's something that I do. And that's why I feel comfortable investing in these companies. I only invest in companies I'm familiar with. I stay within my circle of competence, as Warren Buffett would say. So I used to represent some tech companies when I was in private practice, and so certain tech companies I'm comfortable with. I had a lot of telecom companies that I've represented. So one of the stocks I have, which has a bunch of telecom licenses, and I won't mention the name because this isn't about stock picking, but it's a company that I'm familiar with. I'm familiar with the people who run it, and I've read the SEC filings. I've listened to the conference calls, and that makes me comfortable enough to invest in it. Other companies I don't feel comfortable investing in. I don't have a medical background, so anything dealing with biotech or healthcare, things like that are not something that I would normally invest in. But as I said, things that are within my circle of competence, I feel comfortable investing in. One of the stocks that's come down a lot last year was Google, and it was a big part of my individual portfolio. But because I'm so familiar with it and I think it's such a great company, I kept adding as it went down. So when it went down from I think it was like 120 down to the 90s, I kept buying, and then down to the 80s. I was running out of money, but whenever I got another paycheck, I was throwing money in, and now it looks like that's paying off. It's back up in the 90s. And again, this isn't something that I'm recommending you do. I think most people are better off investing in index funds, but I'm just telling you how I reacted to that market crash. It was a company that I really liked and I was very familiar with. And so if I liked it at 120, I liked it at 90, and I liked it in the 80s. And I knew so much about it that I felt very comfortable putting more in. But if it's a company that you just saw Warren Buffett or another big investor put money in, and then you have no idea why because you haven't been following the company, and then it drops 30%, you might be tempted to sell it because you have no idea why you bought it other than somebody else bought it. But if you've done research, you've done the work, and you're comfortable with the stock, then you can add more to it. And as I said, it's a lot of work, and if you're not willing to put in that work, you shouldn't just copy a big investor. You should just invest in the index fund. It's perfectly safe, and there's no harm in that. Warren Buffett, when he passes away, he left a lot of money to his current wife, and the recommendation that he has for managing her money is to put 90% of it in the S&P and the other 10% in a bond fund, so that she'll have money to pay bills with. And if that's something that the greatest investor in the world recommends for somebody that he cares about who is not familiar with investing, then that's something that you should consider too. So back to my losses. As I said, the house I lost $90,000 in value. That's the only one that concerns me, because if you are thinking of selling in the next year or two, which I am, I would love to have that extra 90,000. Who wouldn't? But if you are thinking of buying a house, the house prices coming down can help you. So that's one way to think about it. And in terms of the stock losses, I'm not retired yet. And so I'm right now a net buyer. I'm not a net seller. If I was already retired and I was selling out of my funds to maintain my lifestyle, then prices coming down would concern me, because I'm selling at a depressed price. But if you're not going to retire for another 10 or 20 years, prices going down can only help you because you're buying at a lower price. So, you're Warren Buffett said you should buy stocks the way you buy hamburgers, not the way you buy perfume. You should want the price to be lower. And if the price goes lower and you have money sitting around, it's a great time to buy. The time to buy isn't when it's going up. It feels good when you see that number going up. It looks like you have more money in your account, but actually when you're buying and the stock is going up, you're getting less value. So as it's going down, if you have money, it's a great time to buy. The only caveat to that is if the stocks keep going down, that usually means the economy is not doing well. And if you are in danger of losing your job or something like that, you're not going to have money to buy stocks, but you're also in danger of losing your house or losing your apartment and suffering other financial harm. So I'm sure that the people who lived through the Great Recession and had jobs, ended up doing really well, but the people that didn't really suffered. So when you're thinking about how much to put in the market, that's one thing to think about is how secure is your job. If you have a secure job where you get that paycheck coming in every week, and you're not worried about getting laid off, then now is the time that you should be more aggressive. And if you are somebody who works in the tech field where they're laying people off, you work on commission where that might get cut, you might want to think about scaling back. And again, this isn't investing advice for anyone in particular. This is just general principles of how to make decisions in time of stress. And that's something to think about now that the markets come down, how to think about your losses. So the 200,000 that I lost in the stock market, 200,000 plus, I'm not particularly concerned about. A certain amount of my paycheck every week goes to the thrift savings plan, which is the retirement plan for the federal government. And as I said, I work for the federal government. My ethics counsel, general counsel have cleared me doing these videos, and they would prefer that if I mention the employer, I give the disclaimer that these are my opinions, not theirs or the agency. But I'm not even going to name the agency. I'll just say that as part of my job, a certain amount every week comes out, every pay period comes out and goes to the thrift savings plan. And I don't even look at that. And that's what has kept me sane the entire time I've worked there. During the great financial crisis in 2008, A certain amount every pay period was just going to the TSP, and that did really well. And it did really well because I didn't look at it, I didn't mess with it, I didn't try to reallocate. It just kept investing. And if you're investing at a time when things are going down, you're getting more value for your buck. Another thing to consider is if you want to buy a house. If you want to buy a house, there's more to it than just the financial aspect. Some people like the idea of owning their own homes. Some people are not comfortable investing in the stock market, whether that be individual stocks or an index fund. They just don't understand it. They don't like the volatility, and they want something that they're going to contribute to. And after 20 years or 30 years, without you knowing it, the mortgage gets paid down, and then you end up with a house that's free and clear, and people like that security. And if you're that type of person, then go ahead and invest in a house. If you're not that type of person, you want to time things, maybe that home ownership isn't for you. But when you think about investing in a house, as I said, there's emotional things that go into it, and other things that are non-monetary. You want your kids to live in a nice school district. You want to be in a nice neighborhood. You want to be in a neighborhood that's close to work. You want to own your own house so you don't have to deal with a landlord. That you can drill holes in the wall and if you want, or decorate it however you want. And those are non-monetary considerations, but they all come with buying a house. So as I said, the house coming down 90,000 this year. If I did sell, that would be money that I lost. But if I buy another house, if I bought the same type of house, I would get that house $90,000 cheaper. So in a way, it's kind of a wash. And usually, if you are thinking short term, buying real estate is a terrible idea because there's very high transaction costs. It's very illiquid, and if you need money right away, it's not going to work out well for you. So if you're thinking of moving in the next 5 years to another city, a school district, you probably don't want to buy a house. But if you like this neighborhood and you want to be there for the long term, it's almost always in your benefit to buy a house. And the way to think about it is the reason it usually benefits you is you're borrowing money in today's dollars and you're paying it back in future dollars, which are probably going to than they are today because of inflation. So my parents, when I was born, they bought a house in Brooklyn, New York in the 70s, and it was $20,000. They sold it in the 90s, and I would never tell my dad what the house is worth now because he would have a heart attack, but it's over $1 million. So from $20,000 to over $1 million, most of that is inflation. And if you think about buying a house, you might be stretching to pay the mortgage at the beginning, but every year your salary will probably go up a little. And if you're renting, your rent will probably go up a little. But if you have a fixed rate mortgage, that fixed rate mortgage, the mortgage payment stays the same. So every year, because of pay raises and things like that, it'll make it easier to pay that mortgage because you're paying it with future dollars, but you borrowed it in past dollars, which were worth a lot more. So generally over time, it gets easier to pay the mortgage because of inflation. There are very few instances where it gets harder to pay because of deflation. But there's times when that does happen. For instance, in Japan, as you've seen for the past 20 years, they've experienced deflation. But if you're not an economist and you can't predict inflation or deflation, since World War II, we've experienced nothing but inflation, and the odds are pretty good that that's going to continue because we keep printing more dollars, not fewer dollars. So that's likely to continue, and that's just something to think about if you want to buy a house. Inflation will probably help you in the long run, and whether you can predict the market going up or the market going down, or interest rates going up or interest rates going down, you can't. There's people that do this for a living with PhDs and they can't do it. And once in a while you'll see somebody on a financial news network where they're giving their opinion on something, and the commentator will say, oh, this person predicted the stock market crash of 2008, and then you look at what their track record is with predicting other things, and it's probably terrible. So a lot of these people got famous for being right once in a row, and you don't want to follow them into or out of anything. Don't take their advice. Yeah, so if they could predict this with any regularity, they would, instead of appearing on TV and trying to sell you their wares. So yeah, as I mentioned, 300,000 down this year. I'm not worried at all. It would be nice if my house kept its value because I would like to sell, but I'll take that. And the fact that the market is down, far from being upset about that, I'm actually happy about that, because there's a lot of stocks that are on my watch list, individual stocks that were too expensive before, but now look really great values. And I did mention Google, and this isn't a stock tip or anything, but as it came down, I was buying more and more. And there are other companies that I had bought, and I had a smaller position because the stock ran away from me. And now that they've come down again, it gives me another opportunity to buy more individual stocks that I'm familiar with, I've done the research, and I'm comfortable owning. And that's the only way that you should buy individual stocks. If not, the market has come down as a whole. And if you want to just keep throwing money into the S&P 500 index through Vanguard or through Fidelity or through wherever else you have, go ahead and do that, because over time, if you're buying when the market is lower, you're going to be very happy. If you're buying when the market is lower, you're getting better value. And unless you're going to retire in the next couple of years, right now you're a net buyer, not a net seller. And as a net buyer, you should be happy when the price is lower, not when it's when it's higher. When you're ready to retire, if the market is going gangbusters up, you'll be very happy. But before you're ready to retire, when you're still in the accumulation phase, you would like the market to be down. And as long as your job is stable, keep adding. The only caveat, as I mentioned, market is going down, it's generally because things aren't going so well in the country. And if that continues over a period of time, that might affect your job prospects, your ability to keep your job, or if you lose your job, to get a new job. So that's something you want to consider. But anything you invest in the market historically over time has worked out well. So there's studies where they've looked at the performance over 5 or 10 years or 20 years. And if you think the market is down now and you want to pull your money out, I would say that's a mistake. Generally, if the market's down and you put it in over a 5-year period, it'll come back. There's only one 10-year period in the history of the market where the market has been down, and if you put money in, you would not have gotten it back within 10 years. But most of the time, if the market's down and you put money in, it'll generally be positive within 5 years. And there's only one period ever in the history of the stock market, a 10-year period, where if you put your money in, it wouldn't have gotten back to positive within 10 years. But there's no period in the stock market where if you put money in, it wouldn't have gotten back within 20. You're 10 years or 20 years away from retirement. Just keep putting the money in, and don't even look at it. Just let it keep compounding on its own, and in a few years you'll be very happy. So that's my thoughts on recent losses in the stock market. And I'd like you to like and subscribe to this channel, because I plan on putting out more content that will be helpful to you. And liking and subscribing to it will let you know when I release a new video. And if you have any questions of things you'd like to see in the future, just put it in the comment below. There's things that I'm interested in and things I'd like to share, but I don't know what you'd like to see. So if you want to see anything in particular, just leave it in the comments and I'd be more than happy to help you out. Have a great day.